All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world, and happy Thursday, everybody. Today is March 13th, 2025, and the top story this morning is once again inflation. Once again, inflation has come down, and once again, inflation is below expectations. This is PPI, or the Producer Price Index, came out just a few moments ago. This measures inflation further upstream, what the producers are paying, what the factories, the makers of stuff, are paying, and it's generally viewed as a precursor of what consumer inflation might be doing in the future. And it came down sharply. And look, this is 2 days in a row of lower than expected inflation data. And a lot of people reacted very poorly yesterday to the commentary and to the CPI reports. So it's important to keep a few things in mind, guys. We talked about this yesterday. Remember, inflation is a rate of change. So when you would see inflation coming down, but it's still a positive number, that means prices are still rising. They're just rising slower. When you see the number getting bigger, that means prices rising and rising faster. If you see a negative number, that means prices coming down. All right. Important distinction. Remember, we're talking rate of change here. Guys, the headline number, 3.2% year over year, that's below the 3.3 expected, and it's down sharply from the 3.7% we got last month. So obviously inflation trending in the right direction, still too high, 3.2%, well above the Fed's arbitrary 2% target. All right, so it's not like we're out of the woods. But the number that jumped out at me the most was core inflation, which strips out food and energy, on a month-over-month basis. That one was actually negative. It was just barely. Consumer or producer prices, not including food and energy, went down ever so slightly for the month of February. And it's important to keep in mind that we're talking about February here right now, because we had some really shocking data came out last week. You guys may remember, everybody last week, especially if you watch FinTwit, there was so much talk about GDP and how the Atlanta Fed's GDP now estimate went sharply negative abruptly. And everybody was like, oh my God, the Trump session and the tariffs and the recession is here. That was mainly driven by some import-export data that we got for the month of January. Now, remember, guys, PPE was sharply higher in January, and the story was that producers are trying to front-run tariffs. They're buying up all their raw materials and all their parts and everything. They're trying to get that stuff into the country before the tariffs hit. And then we got PPI data that supported that in January, and then we got that trade balance data that definitely supported that. And remember, a big surge of imports that subtracts from GDP. And so GDP went sharply negative, according to the Atlanta Fed's estimates. Well, this PPI data that we just got today would suggest that that is now over, that was just a one-off, that all the producers, they scrambled to get everything across the border as quick as possible as they could in January. And they stopped doing that in February, which is why your month-over-month numbers actually went negative, and why we got such a smaller year-over-year increase. Now, we won't know until we get that trade balance data several weeks from now, but this supports the fact, or it supports the theory, that whatever is going to happen with inflation because of tariffs is going to be a one-off. It's going to hit once, it's going to hit hard, and then it's going to be over. Now, we had a lot of people were talking yesterday about the CPI data, and they were saying, oh, look, this goes and proves that tariffs are not inflationary. No, it doesn't, because the CPI data that we just reported yesterday was from the month of February, and there were no tariffs in February, at least no new tariffs in February. So we're not actually going to have any CPI data showing tariffs until next month. But remember, President Trump punted on tariffs, at least for most of them, until April. So even the March data, which is going to be reported in April, won't show the effects of most of the tariffs. And the tariffs probably won't be reflected in consumer prices until a month or two after they're hit. So we may not actually know how inflationary these tariffs are going to be until the middle of the summer, believe it or not. So it's going to take a little while for this stuff to work its way through. But at least for now, based on what I'm seeing with PPI and what I'm seeing with this import-export data, it looks like tariffs are going to be a one-time inflationary shock, and then it's going to be over and it's going to be behind us. Now, that's probably very little comfort to people who are already struggling with the inflation that has already happened. I get that. But again, we're talking macro here. We want to know what is the trend going to be going forward so we can predict what central bankers and how markets might react. And all that data right now is saying it's going to be a one-off. Now, we also got some data from Japan, or a story out of Japan. BOJ Governor Kazuo Ueda was out in the press yesterday talking about how he wants to shrink Japan's balance sheet. Now, that's interesting. Market's not really reacting to that rhetoric. I'm surprised it's not happening because remember that yen carry trade is a big factor in this big sell-off that we've been seeing in tech. And when the BOJ governor is talking about reducing their balance sheet, keep in mind, guys, the largest single buyer of Japanese government bonds right now is the Bank of Japan. They're still growing their balance sheet at a crazy clip. I mean, the modern monetary theory that is at work in Japan is just staggering right now. And he's talking about shrinking the balance sheet, not just slowing the rate at which they're buying, but actually becoming a net seller, which would, and then I have to ask, well, if the BOJ, who is the biggest buyer, turns into a net seller, then who's out there buying Japanese government bonds? The answer is freaking nobody, which means the prices of those bonds are going to fall and the interest rate is going to rise. And so what BOJ Governor Ueda said yesterday was really important, and the market is just shrugging that off. So maybe the market is sick of empty rhetoric coming from central bankers. That wouldn't surprise me. But once you really think about what he's saying, what he wants to do, you'd think the market would react at least a little bit more to that. Now, one area of the market that is reacting to what the central bankers and policymakers are saying is in Europe. And borrowing costs in Europe have been surging for the last 2 weeks. It's continuing again today. This time it is France in the crosshairs. There's an article in Bloomberg talking about long-term borrowing costs in France are rapidly approaching all-time highs. There was a big double top in borrowing costs in France in 2023 and in 2011. And right now we are right back to that level, set to blow right through it. And on Friday, Fitch is scheduled to review France's credit rating. And, well, France's credit rating was already negative because of spending caps and budget crunches and snap elections and governments collapsing. And that was before the revelation that Europe is finally going to have to start paying for its own defense. So I have a hard time believing Fitch isn't going to downgrade the French credit rating on Friday. All that translates into a stronger euro and higher borrowing costs for European governments. We got big news out of Intel this morning. Or I should say late yesterday. Intel's got a new CEO. But more importantly, what does this mean for Intel's fledgling foundry business? Remember, Intel is one of the big beneficiaries of the CHIPS Act. They've been trying or talking about building these magnificent foundries in the United States, and we're going to bring all this domestic manufacturing and jobs back. But there's been very little action on that front. The company is down big time over the last year or so. Well, this new guy who's in charge, he has some particular thoughts on what to do with that foundry business. So you're going to want to see that. And that's actually possibly moving the needle on Taiwan Semiconductor stock this morning. And, well, they really need it because Taiwan Semiconductor and really Taiwanese stocks as a whole have had a really rough couple of weeks as U.S. tech has been selling off, as the AI bubble has been slowly deflating, not quite bursting yet. It definitely has not popped. Not good things for Taiwan stocks if and when that bubble bursts. But maybe this Intel news will give them a little bit of life. We got earnings from Adobe this morning, and, well, they're pretty bad. The market is just saying, hey, where's the beef? You've been selling, and by beef, I mean money made from AI. Where is it? Has anybody seen it? Is it hiding under my desk? Is anybody making money on AI besides no, they definitely aren't? The hardware manufacturers are making money hand over fist, but the people who are actually making AI and selling it, nope. Not making any money, and that includes Adobe. Rather than reporting AI revenue or AI earnings, they're reporting AI bookings. Why would they report bookings? Well, because that includes contracts that are in the works and haven't been signed yet, or future revenue that they haven't banked yet. Because if we actually report AI revenues, well, then you don't have any revenues to report, and then maybe people realize they've been bidding up these stocks for no reason whatsoever. And then on top of that, we got some initial and continuing jobless claims, some more labor data this morning. We'll have that one at the end of the show. But first, we need to shrink my big melon of a head. And let's see what's going on in this market. Don't forget that like button for the YouTube algorithm and that subscribe button so you can come back and have your coffee with the melon heads, because we do this one every morning. And right now, we have got stocks are just barely negative here. The S&P is down 6 points, or 0.12%. The market did turn around slightly around that PPI data. We had a nice green candle at 8:30 when PPI was announced. Still negative, though, but heading in the right direction. The Dow, meanwhile, down 55 points or 0.13% lower ahead of the open. And the NASDAQ is leading the way lower, off by 0.25%, 51.7 points in the red this morning for the NASDAQ. We've got the dollars actually a little bit stronger this morning, back in a 104 handle, 104.06. That is higher by 47 basis points this morning. Now, speaking of the dollar, we got to check in with Japan. And this BOJ's Ueda is upbeat on consumption and warns of too big balance sheet. And I don't know where this guy has been for the last 20 years, but the balance sheet has been too big for some time now. Nice of you guys to finally get around to noticing this one. Bank of Japan Governor Kazuo Ueda on Thursday painted an optimistic view of consumption and reaffirmed the bank's resolve to shrink its too big balance sheet, a sign it remains on course to wean the economy off monetary stimulus. The remarks suggest the BOJ is sticking to its projections of a moderate economic recovery, even as U.S. President Donald Trump's tariff policy jolts financial markets and fuels a trade war that could hurt Japan's exports. And they just had to throw those Trump goggles in there, right? Every story has to mention Donald Trump's tariffs right now. That's just the way the press operates right now. This has nothing to do with tariffs. This is the BOJ saying we're going to stop modern monetary theory. Now, the interesting thing here, the yen not really reacting to this. Actually, the yen is a little bit weaker this morning, believe it or not. 148.33 yen to the dollar right now. This is USD JPY. Remember, if you see this chart moving up, that is the yen weakening. If you see it moving down, that's the yen strengthening. And we were checking in here. The yen has actually weakened 3 days in a row now. We got 3 green candles here after a significant period of strengthening. And I put that little dotted red line there just to show you guys where we are relative to that freak out in August that we had back on August 5th. So we're still not quite to those August 5th levels. We're actually right in the middle of where we were on August 2nd. And I'm very surprised to not see the yen strengthening on this rhetoric from Kazuo Ueda. I guess the market is saying Ueda is full of it because the yen is not strengthening at all. Now, we do have slightly higher Japanese government bond yields. This is the 10-year JGB yield shown on here. That's at 1.538. That's up a little bit this morning after 2 days of declines. Still just off the highs of about 1.58 that we saw a few days ago. The point being here, guys, what Kazuo Ueda said was very significant, and yet the market just seems to be shrugging it off. I'm not sure that is the right call here. Now, looking over at the U.S. bond market, we've got the 30-year Treasury is higher by about 3 points, 4.658 for the 30-year. The 10-year is up by almost 3 points as well, 4.343%. The 2 years at 4.009, that's up about 1.5 points. And the 1 month at 4.286, that's actually down a fraction of a point. Not a lot of movement in bonds this morning. Looking over at the commodities board, we've got mostly red except for gold. Spot gold is up $8, almost $9, $2,942 for spot gold, up 0.33% this morning. My favorite of the shiny silver, though, that's down at $33.08 for spot silver, off by about 13 cents. Or 0.4% lower, but I still like the shiny. Copper's off by 0.5%. Platinum down 1.4%. Palladium is off by 0.65%. And even oil is lower here by 0.84%. April WTI futures are at $67.11. That's off by about 57 cents this morning. Looking over at Bitcoin, guys, once again, we have rejected that 200-day moving average shown in red here. The price is shown on Coinbase this morning, $82,537 off the highs from yesterday. But importantly, guys, you can see here, this is now 4 days in a row that the price of Bitcoin has failed to stay above that 200-day moving average. Support becomes resistance. This is not good for the price of Bitcoin, guys. It looks like we are heading lower here. Now let's talk about these PPI numbers, because the numbers were pretty important, guys. Producer price index, this is headline year over year shown in this chart. Producer prices in the United States increased 3.2% in February of 2025 over the same period in the previous year. So that's your headline year over year number at 3.2%. The market was expecting 3.3%. And you can see here in this chart, that's down rather sharply from the 3.7% that we saw in January. So the front running of tariffs appears to be over. We'll see if we get another surge because they delayed most of the tariffs. Maybe the March data comes in a little bit higher again. We'll have to wait and see for that. Now, on a month-over-month basis, you can really see the difference here now. Producer price inflation month-over-month in the United States, flat, 0.0. No producer price inflation at all for the month of February. The market was expecting a 0.3% increase. And, of course, we are down sharply from the 0.4% in January and the 0.5% in December. Now, here you can see the front running of the tariffs. You bet. I mean, producer inputs went up big time in those 2 months, but now none at all. None inflation. Who had that in their 2020s bingo? Now, for core inflation PPI, this is when you take out food and energy, which are viewed by many as too volatile to include in the larger indexes. Core producer prices in the U.S. decreased to 3.4% in February from 3.8% in the prior month. The market was expecting 3.5%. Now, the language there is a little wonky when they're saying core inflation decreased to 3.4%. Remember, inflation going down, but the number is still positive. So this does mean prices went up. They just went up at a slower clip, sharply lower than we had in January. And this is the number that's probably the most shocking to a lot of people. That is core producer price index for the month over month for February. Core producer prices in the United States decreased 0.1% in February. That is from a 0.5% increase in the month of January. And in this case, the language is appropriate. We have got a negative number. Prices went down in February versus a big increase that we saw in January. Now, the decrease we saw in February, it was a fraction of the increase we saw in January and a fraction of the increase we saw in December and before that November and every other month that they've gone up. So again, this is very little relief to people. I get that, but it's a negative number. That is important. Maybe we get a few more of those in the future. I mean, give people a break. Just a thought. Now, again, guys, this is important because it's the big change from the December and January numbers versus what we see in February as it pertains to this chart. You guys may have seen this one floating around on Twitter the other day. This is the Atlanta Fed's GDP Now estimate. This is their forward-looking forecast on what gross domestic product or the size of the economy is going to do for the next quarterly report. And about 2 weeks ago, this thing nosedived from positive 2.5% all the way down to negative 2.5%, almost negative 3%. And that was all driven. This big decrease was driven by a surge of imports, by that front running of tariffs. So the fact that PPI is now so much lower, even negative on a monthly basis for core PPI, tells me that we may actually see this green line start heading back up. Maybe it doesn't quite go positive, but at the very least, this decline in PPI is showing us that this chart overreacted to the front running of tariffs. So just maybe the inflation scare being caused by tariffs was a little bit overblown. All right, maybe. That's just my takeaway from this PPI data. All right, now let's talk about what's going on overseas in Europe. France's borrowing costs near 14-year high before Fitch review. We may be talking about this one in just a few more days when Fitch gets together on Friday to talk about France's credit outlook. France's long-term borrowing costs are nearing the highest level in over a decade, ahead of a possible downgrade of the nation's sovereign rating on Friday. The 30-year bond yield rose 5 basis points to 4.15% on Thursday, just 1 point away from the most elevated since 2011. The rate is up more than 40 basis points this month due to the sell-off in European bond markets ignited by Germany's plans to boost spending. And this is one case where the media doesn't have their Trump goggles on, because they very easily could have said that this was ignited by the blow-up in the Oval Office between Trump and Zelensky. But they're blaming it on Germany's plan to boost defense spending, which is accurate. But why is Germany planning to boost their defense spending? Because of what happened in the Oval Office. Fitch Ratings is scheduled to review on Friday France's AA negative credit score, which holds a negative outlook since October. The firm last month issued a warning that the country's fiscal consolidation had been scaled back, and since then the government has promised to increase defense spending, placing a further strain on public finances. So the point here is Fitch was already warning, guys, we may cut France's credit outlook, or cut their credit rating. The outlook is already negative, right? You change the outlook to negative. That's a warning that the rating may go down. And then if they don't change things, then you lower the actual rating. Well, they've already got a negative outlook. That was back in October when France was talking about not cutting spending as much. Now they're talking about increasing spending on defense. Well, how I have a hard time believing Fitch is not going to cut France's credit rating based on that news. If they were already warning and then things got worse, well, then what's the point of the warning? And just to put that in perspective, guys, this is France's 10-year government bond yield. They were talking about the 30-year in that article. I like to look at the 10 years. Right now, 3.576. You can see a big increase that we saw. That was largely driven by that blow up that we had in the Oval Office. And, of course, plans for Germany to increasing spending. It's continuing to creep up. Now, if we zoom out, you can see we were at this level back in October of 2023. We're right back around those levels. And if we zoom out even more, we got to change this to, say, a monthly candle. You can kind of see what Bloomberg was talking about here. Now we got to zoom in a little bit. All right, you can see, all right, this is the highest level that we have seen since 2011. It's not going to get any cheaper, guys. If France is talking about rebuilding their military along with the Germans and the rest of Europe, they're already having a budget crisis. That means they're going to have to borrow more money. And ultimately, I think this is leading to the European Central Bank return to ZERP, possibly NERP, negative interest rate policy, and certainly the BER will be coming back, or les BER, if you want to parlez-vous français. Sure, why not? Les BER. All right, changing gears. Let's look at Intel here. Intel stock soars as Lip Boutin is named CEO, but he faces a tough task ahead. New CEO, new leader in town, and Intel shareholders are loving it. Months after leaving Intel's board of directors, Lip Boutin is returning to the struggling chip giant in a much bigger capacity. He was named Intel's new CEO on Wednesday afternoon, set to replace interim co-CEOs David Zinsner and Michelle Johnston-Holthaus, who have been holding down the top post since December. That's when Gelsinger, their previous CEO, left. When he officially assumes his roles on March 18th, Tan will be tasked with restoring Intel to stability and trying to get the company back to its former glory as a chip powerhouse. Within a few minutes of the news, Intel shared an internal email that Tan wrote to employees after his appointment. Keeping Intel's core strength as an engineering company is a big part of Tan's vision, but the bigger question investors are asking is whether he wants to split Intel into two parts or keep it as one separate manufacturing subsidiary. Now, this is interesting because Tan left Intel's board back in August amid reports that he didn't agree with former CEO Pat Gelsinger's plan to keep Intel together as one company, with the manufacturing business as a separate subsidiary, but still part of the larger Intel. The split will come back into the headlines because he was associated with having a strong appetite for the split. At least that was the belief, said Daniel Newman, CEO of the Futurum Group, who told MarketWatch on Wednesday, but he never publicly disagreed with the idea of one Intel at the time. So Lip Boutin left the company. He left the board of directors back in August. He never explicitly stated it, but it was believed that he did it because he wanted to split the company up. He wanted to sell off the foundry business, probably to a joint venture with Taiwan Semiconductor, and then keep Intel as a standalone engineering firm. Well, now he's back in the CEO role, so it looks like he may have been bought back for the sole purpose of splitting up the company. Or at least that's the idea. And typically when you split up a company, the shareholder value is unlocked. The two parts or the sum of the parts is greater than the previous whole. And you can see that happening with Intel shares. They were up 4.5% yesterday. They're up another 14% this morning ahead of the opening bell, $23.60, up $2.92. So Intel shares are ripping higher here. Look for news over the next few weeks to see if they actually spin off their foundry business. And then what could that mean for CHIPS Act funding? What could that mean for tariff stories? Because tariffs on semiconductors is a big question mark in the market right now. Now, I also believe this may be related to a sudden reversal of Taiwan Semiconductor yesterday. Now, there was a lot of negativity around Taiwanese stocks before the Intel story broke. Take this one from Bloomberg. Taiwanese stocks suffer record foreign selling as TSMC is dumped. Taiwan shares saw their worst ever selling streak by foreign investors as heavyweight Taiwan Semiconductor fell out of favor. Global funds reduced holdings for the past 12 sessions, shedding a net 391 billion Taiwanese dollars. It's about $11.9 billion worth of Taiwanese stocks through Wednesday, according to exchange data compiled by Bloomberg. Taiwan Semiconductor, which accounts for more than a third of the benchmark's weight, fell nearly 10% during this period as foreign investors dumped 55 million shares. The tech-heavy market has been caught in this year's drawdown in global chip stocks as concerns mount over the sector's frothy valuation. Investors who once couldn't get enough of leading AI stocks have turned more selective in the wake of DeepSeek's success, which threw into doubt the notion that China is far behind its global competitors in developing AI. Now, you can see here this sell-off. Here is what they're talking about in this article. This is that 2-week-long sell-off that we saw in Taiwanese stocks. They were dropping precipitously along with the NASDAQ, along with names like NVIDIA and Supermicro and all the big AI darlings. Now, here's what I want to zoom in on, and my moderator, Mish, was very astute in pointing this out. Look at the wick on this candle from yesterday here. You can see a big intraday reversal yesterday. Taiwanese stocks were selling off like crazy, and then they reversed. They still closed negative yesterday, but now they're positive today. And I'm wondering, is it this news from Intel, this new CEO at Intel, who is in favor of splitting up the company, causing that big reversal in Taiwanese stocks? Because who would Intel partner with if they were going to split up the company and then make some kind of joint venture in their foundry business? Well, Taiwan Semiconductor is the obvious choice for that. So it's possible this Intel news is affecting this reversal in a major sell-off in Taiwanese shares. One more AI story this morning. Adobe stock has been an AI laggard, and a ho-hum earnings forecast is adding to its decline. Adobe's breakout of AI bookings was also slightly weaker than expected. And the fact that they're reporting bookings instead of revenue or earnings is a dead giveaway that there really are no revenues and earnings to report. Adobe system shares fell in after-hours trading Wednesday after disappointing quarterly earnings guidance amid criticism of Wall Street that the software company is not yet monetizing artificial intelligence. And that's not unique because nobody is yet monetizing artificial intelligence, something I've been screaming from the highest mountaintop for a year and a half now. Nobody wants to hear it. Adobe, which has seen its shares tumble as investors have waited for the company to make money in AI, appeared to be trying to address the issue by giving analysts AI software bookings data for the quarter. Adobe is well positioned to capitalize on the acceleration of the creative economy driven by AI, and we are reaffirming our fiscal year 2025 financial targets, said Adobe CEO Shantanu Narayan in a statement. The company also said that it exited the first quarter with over $125 million in bookings for its new AI standalone and add-on innovations. Remember, guys, bookings is not revenue. Bookings is a theoretical, hypothetical estimate of total future revenue that might be generated by their standalone and add-on AI innovations. Why would they report bookings? Well, because they got no revenue. You ain't got no earnings, Lieutenant Dan. That's why you're not reporting it. Adobe stock not reacting well to that bookings data, down 7.66% ahead of the open after those earnings here, off by $33.60, trading at $404.50 this morning. And last but not least, we got some labor data this morning, and labor data actually wasn't that bad. It wasn't good per se, but it wasn't terrible. Initial jobless claims in the United States fell by 2,000 to 220,000 for the first week of March. That's the lowest in 3 weeks and below market expectations that it would rise to 225,000. So initial jobless claims still not really reflecting any surge in joblessness, despite that big jump in job cuts that my friends over at MacroEdge were tracking, not really showing up here in the initial claims data. We did have a big spike at the end of February, but since we have come down. So the big surge of layoffs still yet to materialize in the labor data. Maybe these government job cuts are eventually going to reflect in this data, but it still is not really showing up here. And continuing jobless claims, all right, they rose a little. Actually, they're down, but down not that much. Continuing jobless claims in the U.S. decreased to 1,870,000 in the week ending March 1st of 2025 from 1,897,000 in the previous week. So we got a drop of about 27,000 continuing claims here, people finding jobs. Continuing claims in the U.S. had averaged a lot higher than that for most of history. We're still stuck in this band here, guys. You know, we've kind of been bouncing around at this level, since October of last year. The takeaway here is the weekly jobless claims data still not showing any significant weakening in the labor market. So We got inflation numbers. They're coming down from elevated levels, but they're coming down without any big problems in the labor market. So, overall, I'd say the data this morning was pretty good. There are some things to worry about, and there's some things to be encouraged about. But on the whole, I think things went pretty well here. And that's about all we got for you guys this morning. So, look, inflation coming down, still too high. I think the tariff worries about inflation may be getting a little overblown. We haven't yet seen any of that in the data. We'll eventually gonna see it. But the fact that we've got PPI coming down so sharply, despite that big drop in the GDP now and everybody freaking out over the import data, it didn't last. All right, PPI is already coming down, which would suggest those imports will come down next month from the ridiculous surge we saw last month, which means whatever the effect of the tariffs are, it's going to be a one-off, not a sustained thing. Still going to hurt, though. It is going to hurt. It's just not going to be a prolonged, agonizing pain. It's going to be like getting a shot. Ow, that sucked, but it's over. All right, guys, I just want to say thank you so much for having your coffee with the Melonheads this morning. Shout out to my magnanimous Melonheads on Patreon and YouTube. You guys are awesome. Thank you for everything you do for the channel. Looking forward to talking to you guys tomorrow at 2 p.m. for our weekly get-together on Zoom. Links down below should you feel so inclined. Don't forget that like button and that subscribe button on the way out. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.